Last week was definitely consolidation because we had 5 days where the market opened higher and closed lower. They call that bearish engulfing. It makes sense because we're consolidating that 28% gain from the April lows. On the job stuff, I think it's just the data's catching up to what we already know. The labor market's been soft, right? So it's, I think, a positive setup because now the Fed has more ammunition to make a dovish pivot in the fall. And it's not too late because we know the thing that they're going to stimulate is the housing market. And so that is what strengthens the economy in 2026. So I think it's quite a positive setup. We're just consolidating and then we make a bigger move higher. I think when they look at their dual mandate, they're probably drifting further from the employment metric now because the unemployment rate, if you use the existing participation rate before this report, it's almost 5% now. So the Fed now has to be considering the risk of jobs market actually going into a cycle of weakening. The goods component that are tariff-driven, it's been only mild. But also, if you use the same inflation measure Europe uses, which is inflation ex housing, we're actually under 2%. The Fed, if they were the ECB, would be cutting right now.
What time frame?
I think we're going to rally pretty strongly in August. So I think, yeah, I think we can get back to 65 or get to 65, 6,600 all-time highs in the next couple weeks.
And then 7,000 in the next 12 months above that?
Yeah, probably well above that.